How a debt to income ratio is going to impact your portfolio as a property investor. Hi, I'm Ed McKnight, economist here at Opes Partners, and in today's video, we're going to talk about debt to income ratios, what they are, and how they're going to potentially impact your property portfolio as an investor. Now, let's first start by talking about what debt to income ratios are. It is essentially a limit on what you are able to borrow, and it's tied back to your income. So if we think about BNZ's debt to income ratio, which they have just introduced, which is 6 times. What you do in that case is take your annual income before tax, multiply it by 6 in this case. That is the maximum amount that you are able to borrow. And we'll go through some case studies in a minute. But what's important for you property investors to note as well is that this annual income, it does include some amount of rent. Usually they'll take the annual amount of rent and scale it down to about 80% of that income. But the amount that they'll scale it down does depend on which bank you're with, and this can change from time to time. Now, the debt to income ratio that has got all the attention over the last couple of months is BNZ's, which is 6 times income and was introduced in October 2021. It's 6 times income. But what a lot of borrowers aren't aware of is that ASB actually brought in a debt to income ratio of 6 to 7 times income back in November 2020. So we're sitting here freaking out about BNZ's debt to income ratio, but actually we've already had one in place at one of the major banks for the last 11 months, and a lot of people didn't even notice. Now, what's the key message there? Well, even if a debt to income ratio is brought in, it doesn't necessarily mean that you're going to be unable to borrow, and I'll give you some case studies in a moment. The other thing that's been really hot in the media, which I think is a bit of misinformation, is this idea that it only affects mortgage brokers. Now, what's important to note is that all lending across BNZ is affected by the debt to income ratio. But some media organisations have reported that it only impacts mortgage brokers. Now, what's the actual case is that mortgage brokers, at least this is our understanding, have that hard limit of 6 times income. If you go direct to the bank, you can sometimes get up to 7, but across all of BNZ's lending, it's got to be a maximum of 6, is our understanding right now. Now let's go through some of those examples to see, well, how would a debt to income ratio impact my ability to borrow? Well, let's start with an owner-occupier example because these are really simple. Let's say that you've got household income of 150k. So maybe you and your partner earn 75k each. Multiply it by BNZ's 6 times debt to income ratio, the maximum you're able to borrow is 900k. Now, here's the thing. If you're purchasing a property as an owner-occupier, you don't just have your mortgage, you've also got your deposit. So let's say that you are purchasing with a 10% deposit. Now that means the maximum you could purchase with is $1 million property if purchasing as your first home and using a 10% deposit. Now, where this gets really interesting is when we start to talk about property investors, because we've got to include the rental income as well. So let's again say it's the same couple, but now they're looking to purchase an investment property. So 150k household income multiplied by 6, 900k maximum borrowing. But because they're looking at an investment property, let's say that they purchased a couple of years ago when properties were cheaper, and let's say they've paid down some of their mortgage. So maybe they've got 300k left on their personal mortgage. Now what that means, 900k, what they could borrow, minus that 300k, that means they've got 600k left that they are able to borrow under the debt to income ratio. But of course, we've got to factor in rent as well. Now, when we've run the numbers, we think, look, a maximum of 24k rent is what they'd be able to bring from that property and have accounted for or have counted under the debt to income ratio. So that's after we've scaled it. Now, 24k, that's based on about a 4% gross yield. So what we've got to do, add that into the income, multiply it by 6, and what do we get? Roughly about 750k, just under 750k is what this couple would be able to purchase using a debt to income ratio and going out and purchasing that first investment property. Now, with BNZ bringing in that debt to income ratio, you might be thinking, well, why don't I just go off and check out all of the other banks? Why don't I just go to ANZ? Why don't I check out Westpac? Well, here's the thing. Although the debt to income ratios are getting all of the attention right now with the focus clearly on BNZ, what's come in and what's also on the red carpet but isn't getting as much attention are servicing changes. And what I mean by this is the banks changing their algorithms, changing their Excel spreadsheets, which are making getting lending for for investment properties a wee bit tougher. Now, what's interesting is that these servicing changes are having just as much impact on investors' ability to borrow as the debt to income ratios, but they're not getting the same attention. And the reason for that is that they're harder to explain and they just haven't been publicized as much. So I want to give you an example of an investor that we've been working with, a couple, who have had the amount that they are able to borrow limited by different banks. Now, this couple have total lending of about $1.7 million right now. They own 4 investment properties and their household income is $180K. That's before the rental income. Now, what we did is before these changes all came in, they were in the position to be able to purchase another investment property. They were able to fund property number 5 for somewhere between $600,000 and $700,000. Let's look at the amount of money they would be able to borrow after these changes came in. Well, bank number 1, who has a debt to income ratio, they wouldn't even lend them what they currently have borrowed, so about $250K less. Bank number 2, also with a debt to income ratio, they'd lend them, just shy of what they currently have. Bank number 3, no debt to income ratio, but actually significantly less than what they've currently got in terms of borrowing. And the last bank, again without a debt to income ratio, they'd lend them an extra 150 odd K, but not as much as that $600 to $700K that they were initially hoping for. Now, the key point that I've got here for you is that the bank that was willing to offer the lowest amount of lending actually didn't have a debt to income ratio. This couple could have gone, or could go theoretically, to a different bank and get a higher amount of lending. Similarly, the other thing to point out is just the difference between how much the lowest lending bank is willing to offer these borrowers compared to the bank that was willing to lend the highest amount. There was almost a $500,000 difference between the two, which is astronomical. Now, what's the key message there? First of all, don't be necessarily worried about these banks have got a debt to income ratio, so I'm not going to deal with them, because actually they might be willing to lend you more money than some other banks. Second thing I think that's really important is to make sure you're working with a really experienced mortgage broker, somebody who's going to go out, run your numbers through all of the different algorithms, run your numbers through all the different Excel spreadsheets, and find the bank that is going to have the best lending solution for you and your situation. But look, the key message is that bank servicing is getting tougher, and that is where you will also need to consider looking for some other opportunities. And what I mean by that is, let's say that there is a group of people who aren't going to be served going forward from the main banks. Well, that's where these people might decide that, hey, I'm going to go and consider using a non-bank lender. Now, these are the sorts of institutions like a Bluestone, an Avanti Finance, or Resimac. They're lending money out to people who want to purchase properties, but they're not banks. They don't take deposits, they don't do term deposits, and just fundamentally they are not a bank. But what they will do is still lend for properties. Now, this is where we expect to see non-bank lenders become much, much more popular here in New Zealand. And the reason behind that is, if we look across the ditch, across the Tasman, to look at Australia, about 20% of mortgages written, our understanding is, are written by non-bank lenders. So non-bank lenders have 20% of the mortgage market. Over here in New Zealand, how much do you think it is? 2%. Much, much smaller, about 10 times smaller as a percentage here in New Zealand compared to Australia. Now, with all of the servicing become harder, with being able to borrow money becoming tougher, we do expect that more people will start to look at non-bank lenders. So what's the key message here? First of all, debt to income ratios have been here in New Zealand for over a year. And in some cases, we haven't actually noticed them. The second thing to point out as well is, just because a bank has a debt to income ratio doesn't mean that they're necessarily going to lend you much less than another type of bank. And the third thing to point out is we must start to just consider non-bank lenders and really working with a mortgage broker to make sure that we are getting the best lending situation for us. Now, hey, if you want to learn more about property investment, check out the Property Academy podcast, because every single day we release a new 10 to 15 minute-ish episode to teach you something new about property right here in New Zealand. You can check that out on Apple Podcasts, Spotify, or your favorite podcast listening app.